Hey, look, I was working on something, but they wouldn't let me finish it, so take a look at it. Be careful.
Hello, my name's Deborah Taylor, and I'm a trainer at Financial Edge. Before becoming a trainer, I spent nearly 10 years working in investment banking, and I'm going to draw on some of my experiences to review the movie Margin Call. Now, the movie is set at the start of the global financial crisis in 2007, and the movie gives a fictionalised account of a fixed income sales and trading department during a rather stressful 24-hour period where they realise quite how much risk they have on their balance sheet. Now, although some of the script in the movie is a little bit painful, for example, they reference the fact that their potential losses are greater than the entire market capitalisation of the bank, the movie is actually really well researched and provides some great learning points to understand the workings of an investment bank, particularly at a time of extreme stress. Now, although Margin Call does focus on a financial crisis that happened over a decade ago, it's actually super relevant to us today, considering that we are currently dealing with another economic shock, which is, of course, a global pandemic. Now, these economic shocks can be really useful learning experiences because they remind us that the economy is a dynamic system that periodically does have moments of stress. And it shows us how companies and markets react to these stresses. So let's have a look at a few scenes from the movie and see what we can learn from Margin Call.
Hey! Look who's burning the candle at both ends. Why didn't you come out with us? There's no more cuts planned. You don't have to kiss my ass. I frankly don't even know what it is you guys do.
Well, I'm really sorry I had to bring you guys back here, but...
That's all right.
What's going on? Look at this. Eric gave me this file before he left.
Eric?
Dale, and he told me that he couldn't quite figure it out, and the last thing he said to me before the elevator doors closed was, "Be careful."
He said, be careful?
Yeah, so obviously I'm a little curious. I start to get into it a little bit, and I realize that the only thing that he's missed... This is not good, Will.
Right, okay, so what is he doing here?
No, go to Model 4. It makes more sense.
Okay. All right.
What is this?
This is basically everything that we have in our books at any given time. But what Eric was trying to do was to work these numbers for levels of volatility that fall outside of the standard VAR model.
What are those levels?
It's fairly complicated.
Simplify it.
The volatility levels are set using historic patterns, basically, and then stretching those patterns out another 10, 15% roughly.
All right, so?
So we are starting to test those historic patterns.
When?
Today,
Tuesday.
Monday, last Friday and Wednesday.
Two Fridays ago.
All right, I get it.
Fuck me. Once this thing gets going in the wrong direction, this is fucking huge.
How huge?
Well, the losses are greater than the current value of the company.
Projected losses. The projected losses will.
And this is just our floor?
Yes.
So in this clip, they mention the phrases volatility and VAR. But what do these mean? Well, volatility measures how much the price of a security changes over time. Let's say, for example, a company's share price. If the share price stays quite stable, then this is described as having low volatility, whereas if it moves around significantly, that means it has high volatility. Now, investment banks have huge amounts of securities on their books, and those fluctuate each trading day. And that means it's really important that they have some way of monitoring the volatility of the securities that they have on their books. And that's the job of the risk management department. Now, VAR, or value at risk, is a key metric used by risk management to understand the risk associated with the volatility of a security that they hold. Now, one way to calculate VAR is to use historic price information. Let's take an example. If we look at a company's share price over the last year, and on only 1% of the trading days, the share price fell by more than 5%. That means 99% of the time, the share price has fallen by less than 5%. And if we use that historic information to predict future share price movements, well, that implies if we hold $100 worth of the stock today, then over the next year, we can be 99% confident that losses will not exceed 5%. Or $5. So this information helps the risk management department to set VAR limits for each trading book and for the trading floor as a whole. And this VAR limit expresses the maximum losses which are acceptable to the risk management department and help to protect the bank from major losses.
So, Sam, what do you have for us?
They'll be here in a minute. Finding somebody in the copy room at this hour was a little bit of a challenge.
Okay, let's go right into the introductions. This is Sarah Robertson, who you know, Chief Risk Management Officer, Ramesh Shah from upstairs, and David Horn, one of the firm's in-house counsel.
Nice to meet you all. This is my head of trading, Will Emerson, and this is...
Peter Sullivan and Seth Bregman. And they work in our risk department.
Where's Eric Dale?
He was let go today.
Who do you have left in your risk department?
As of today, that would be Peter and our junior analyst, Seth.
Really?
Will Emerson.
Yes, please, just hand them up.
This scene gives a really great introduction to some of the key roles in an investment bank. Demi Moore plays Chief Risk Management Officer, so she heads up the risk management function, and they're responsible for overseeing the risk exposures of the trading floor, including monitoring compliance with the VAR limits that we've just looked at. Asif Manvi plays in-house legal counsel, that's the legal department for the bank, and they work closely with the risk management function to help manage the firm's legal risk. We also see Paul Bettany play head of trading, so that's the person with the oversight for the firm's trading activities. Typically, the trading floor is divided into desks, with each desk focusing on different trading activities, for example, different asset classes or different regions, and all of these desks then report into the head of trading. Kevin Spacey plays head of sales, and it's the sales team that manage client relationships. So sales are often the ones that know which clients will be interested in buying or selling, even though it's trading that will actually conduct the transactions. And that's why sales and trading work so closely together on the trading floor. Now, the one thing I think is a little bit surprising in this scene is that the head of risk and the heads of sales and trading are having to introduce themselves to each other in this meeting. Whereas I think in reality, heads of risk and heads of sales and trading will often meet regularly to discuss areas of concern such as limit breaches.
But yes.
What's your background?
My background?
Your CV?
I've been with the firm for 2.5 years working with Eric that whole time, but I hold a doctorate in engineering, specialty in propulsion from MIT with a bachelor's from Penn.
What is a specialty in propulsion exactly?
My thesis was a study in the ways that friction ratios affect steering outcomes in aeronautical use under reduced gravity loads.
So you're a rocket scientist?
I was. Yeah.
Interesting. How did you end up here?
Well, it's all just numbers, really. Just changing what you're adding up, and to speak freely, the money here is considerably more attractive.
So this is a really interesting scene because we hear about this person's background and find out that he has a doctorate in engineering. Now, you might think that this seems quite unusual to find someone with this kind of background working in an investment bank. But actually, the reality is investment banks recruit from a whole range of degree disciplines, not just those with finance degrees. And that's because it's really beneficial to have a broad base of experiences and skills across the different divisions of an investment bank. In fact, I myself have a physics degree, and I was certainly not alone in having a science background when I started working in investment banking. Also, working in finance does require a certain amount of confidence when working with numbers, so those with qualifications in engineering, maths, and science in particular can find investment banking a great career to transition into.
All right, so what do you think Rogers makes in a year?
I have no idea.
Come on, play along.
What year? I don't know.
Last year.
$750,000.
Come on.
What?
Oh, it's not even close.
More?
Much more.
$1 million?
No, Will Emerson made $2.5 million last year.
Fuck you.
Fuck me.
Fuck you. How do you know that?
He told me.
He just told you
No,
that.
I asked him, but yeah, he told me.
Do you think that's true?
Yeah, probably.
It's fucked up.
Why is that fucked up?
I don't know. Does it seem right to you?
Right. I mean, right is.
Wow. Earning $2.5 million in a year? That sounds amazing. And we often hear really large figures being thrown around when people talk about how much investment bankers earn. However, in today's environment, it really isn't the norm to be taking home $2.5 million in a year. And really, it would only be management, such as the head of trading, as in this scenario, that would take home seven-figure paychecks. In reality, starting salaries for junior analysts are closer to $80,000 to $100,000 in a year, usually with bonuses adding maybe between 30 to 50% on top of that. It's worth noting that bankers usually talk in total compensation or total comp terms, which means salaries and bonuses added together. One final thing to note is that most firms do treat compensation arrangements as confidential, so it really isn't recommended to go around asking other people what they earned last year.
What have I told you since the first day you stepped into my office? There are three ways to make a living in this business. Be first, be smarter, or cheat. Now, I don't cheat. And although I like to think we have some pretty smart people in this building, it sure is a hell of a lot easier to just be first.
Sell it all today.
So it's quite a bold statement to say that to succeed, you need to be first, be smarter, or cheat. Well, clearly the bank CEO takes a sensible approach in not endorsing cheating. Banking is a regulated industry, and it's absolutely crucial to follow both the letter and the spirit of the regulations. And this became even more important after the global financial crisis, when regulations became more stringent and the level of personal accountability increased for those working in the industry. However, it is worth mentioning that banking is a competitive industry. And my own personal view is that to succeed, it isn't about being first or being smarter. It's about being ambitious about what you think you can achieve and being prepared to work really hard to achieve that. I also think there isn't a need to be aggressively competitive with the people that you work with. In fact, most investment bankers are working in teams, and so it's important to be a team player. However, being surrounded by other smart and motivated colleagues is great because it can help to motivate you in terms of your own performance.
Well, as you probably know, over the last 36 to 40 months, the firm has begun packaging new MBS products that combine several different tranches of rating classification in one tradable security. This has been enormously profitable, as I imagine you noticed.
I have.
Well, the firm is currently doing a considerable amount of this business every day. Now, the problem, which is, I guess, why we are here tonight, is that it takes us, the firm, about a month to layer these products correctly, thereby posing a challenge from a risk management standpoint.
And Mr. Sullivan, that challenge is?
Well, we have to hold these assets on our books longer than we might ideally like to.
Yes.
But the key factor here is these are essentially just mortgages, so that has allowed us to push the leverage considerably beyond what you might be willing or allowed to do in any other circumstance, thereby pushing the risk profile without raising any red flags.
Now, thank you, Mr. Sullivan. Sit down. What I'm guessing your report here says, and give me some rope here. What I'm guessing it says is that, considering the, shall we say, bumpy road we've been on the last week or so, that the figures your brilliant co-workers up the line ahead of you have come up with don't make much sense anymore, considering what's taking place today.
Actually, not what's taking place today, but what's already taken place over the last 2 weeks.
So you are saying this has already happened?
Sort of.
In this scene, they throw around the phrase MBS products. Now, if you're not familiar with this acronym, it refers to mortgage-backed securities. Now, mortgage-backed securities are a type of fixed income security, so a bit like a bond. This means that the investor purchases the security with the expectation of receiving coupon payments and also eventually repayment of the principal amount. However, where MBS products differ from bonds is that the borrower isn't a single company. Instead, it's a bundle of mortgages which have been packaged together, usually by a bank, and then placed into an investment vehicle which then issues the securities to the investors. Now, during the early 2000s, these asset-backed securities were hugely popular with institutional investors, such as pension funds and insurance companies, as it offered a way for them to invest in banking assets, such as mortgages and credit card receivables, which they otherwise wouldn't have been able to invest in. And they had the added benefit that they offered great returns at apparently low risk. Now, unfortunately, the quality of the assets used for these securities started to fall, and some very high-risk loans, known as subprime loans, were being bundled into these securities, but still being marketed as very low-risk investments. Now, in mid-2007, the US house price market started to fall. And when some borrowers defaulted on their home loan repayments, the financial markets gradually started to realise that these securities were much riskier and therefore worth significantly less than they previously thought. And we're talking really big numbers here. Over the course of a few days in 2007, the value of these investments fell by trillions of dollars.
Well, you call the traders in for the normal 6:30 meeting and you be honest with them, because they're going to know it's the end either way. So you're going to have to throw them a bone, and a pretty big one. And then you've got to come out of the gate storming. No swaps, no nothing. 40% done by 10:15. By 11 o'clock, all your trades have to be gone, because by lunchtime, word's going to be out. And by 2 o'clock, you're going to be selling at 65 cents on the dollar if you're lucky. And then the feds are going to be in here up your ass trying to slow you down.
Ramesh?
They can slow you down. They can't stop you. It's yours to sell.
Yeah, but John, even if we manage to pull that off, and that's saying something, the real question is, who are we selling this to?
Same people we've been selling it to for the last 2 years, and whoever else will buy it.
But John, if you do this, you will kill the market for years. It's over. And you're selling something that you know has no value.
We are selling to willing buyers at the current fair market price, so that we may survive.
You will never sell anything to any of those people ever again.
I understand.
Do you?
Do you? This is it! I'm telling you, this is it!
In this scene, the CEO has decided to sell the bank's mortgage-backed securities for whatever price buyers are prepared to pay, even though they know that they have no value and that this course of action will potentially seize up the credit markets. But I think that this scene does cause us to think about what we mean when we ask the question, what is something worth? And the reality is that we can define value in a number of ways. The CEO of the bank argues a fair market value is what someone else is prepared to pay. But the head of sales argues that the securities are essentially worthless. And here he's referencing the fundamental value of these securities, meaning the value of a security based on its cash flows. For example, if I know that I buy a bond today that will give me $100 of cash flow in a year's time, well, if I can work out what that $100 in a year's time is worth to me today, then that gives me the fundamental value of the bond. So if the head of sales says that the securities are actually worthless, he's basically telling us that anyone buying those mortgage-backed securities will not receive even 1 cent in coupon or principal. There is actually a third way that we can define value, and that's liquidation value or fire sale value. And this brings us neatly onto our next scene.
Thank you all for coming in a little early this morning. I know yesterday was pretty bad, and I wish I could say that today's going to be less so, but that isn't going to be the case. Now, I'm supposed to read this statement to you all here, but why don't you just read it on your own time, and I'll just tell you what the fuck's going on here. I've been here all night, meeting with the executive committee, and the decision has been made to unwind a considerable portion of the firm's holdings in several key asset classes. The crux of it is, in the firm's thinking, the party's over as of this morning. There's going to be considerable turmoil in the markets for the foreseeable future. And they believe it is better that this turmoil begin with us. As a result, the firm has decided to liquidate its majority position of fixed income MBS today. These are your packets. You will see what accounts you're responsible for today. I'm sure it hasn't taken you long to understand the implications of this sale on your relationships with your counterparties and, as a result, on your careers. I have expressed this reality to the executive committee, and they understand. As a result, if you achieve a 93% sale of your assets, you will receive a $1.4 million one-off bonus. If the floor as a whole achieves a 93% sale, you will get an additional $1.3 million apiece. For those of you who've never been through this before, this is what the beginning of a fire sale looks like. I cannot begin to tell you how important the first hour and a half is going to be. I want you to hit every bite you can find. Dealers, brokers, clients, your mother if she's buying. And no swaps. It's outgoing only today. Obviously, this is not going down the way that any of us would have hoped, but the ground is shifting below our feet. And apparently, there's no other way out.
So this scene demonstrates a really typical event for sales and trading, and that's the morning meeting, which usually happens at about 6:30 each morning and is attended by all of sales and all of trading. Now, it provides an opportunity for them to agree the priorities for the day, to discuss any particular positions to focus on, and also to discuss any news flow which is likely to affect the markets. However, the content of this particular meeting is not at all typical, as they're being asked to liquidate huge positions held by the bank, which will in itself fuel the financial crisis. Also, they reference the term fire sale, and that's used to describe the sale of securities under distressed conditions. So usually it means that the seller is prepared to accept a price which is well below the usual market price.
City.
Hey, it's Will Emerson.
William, how are you?
I'm all right. How's the trouble and strife?
Busting my ass as always.
You see, that's why I tried to tell you, John. Why do you think I'm single?
I know you did. What can I do for you?
Listen, I just got the tap on my shoulder, and we've got some risk over here that we need to move. So today it looks like my loss is your gain.
What kind of size we talking?
Should be on your screen. I just sent it.
Jesus, where does this land?
96 on the dollar.
91.
All three, and we're done at 94.
93 and a half.
Done.
Trading.
Hello, gorgeous.
Will, what's happening over there?
Well, today's moving day.
Fuck are you guys so worked up about?
You think they tell me anything? All I know is that today my loss is your gain. Now, you're a friendly, so I'll come to you first. I got 270 mil, 15-year paying out a 1.5 above par.
Where's it from?
Where's it from? Do you care?
No, not really. Now, where's the trade? I'm hearing things
Alexis,
and you guys are scaring
I'm only
me
sharing this with you right now. 85.
Done.
Deutsche?
It's Will Emerson.
Fuck you, you limey bastard.
Come on, you still angry about that?
Word is out. I'm hanging up now. Meryl,
Lawrence,
What the fuck are you guys doing over there?
just a little spring cleaning.
That is not what I'm hearing.
All right, Lawrence, are you a buyer?
I'm not sure anymore. Where at?
Well, it sounds like I should be asking you where at.
What are we talking about here?
375 mil, 30-year mixed.
Fuck me.
Are you with me on this?
63 cents.
Oh, fuck you, I'm hanging up.
63.
Let me call my man here, I'll come back to you in 5.
Maybe 55 and 5.
Well, all right then, stay on the line. Sam, pick up the phone. Sam, get on the line.
Yeah.
I got Lawrence and Merrill.
Where are we?
63 cents.
Jesus. On what?
375 of mixed 30.
Get him to 65 and hit it.
Are you fucking kidding me? What is that? That's a $131 million loss on a single trade.
I understand. Hit it.
Hey, Lawrence, we're Phil Kill at 65.
It's filled.
So, the tension in the movie is now peaking as the traders try to liquidate their positions. You might notice that the prices are quoted by the traders in cents. So they reference the phrase 96 on the dollar, that means 96 cents on the dollar, and that's typical for fixed income securities where prices are quoted out of 100 with reference to the notional or principal amount. So if the principal amount on the bond was $100, the trader is asking for $96. However, as you can hear during the negotiations, the buyer isn't prepared to pay 96 and their bid is 91. Eventually both parties settle for a price of 93.5. Now, the difference between the bid and the asking price is known as the bid-ask spread, and typically this widens during times of stress or when there's a lack of liquidity in the market, simply because there's just less certainty over the market value. But by the afternoon, prices are tumbling and they're down to 65. And the end of the scene references a fill or kill order. Although this sounds really ominous, it is just a type of market order which requires all of the block of securities to be transacted at the agreed price, otherwise the trade is abandoned. Now, at the end of the scene, we can hear the clanging of the bell, which marks the end of the trading day as the markets close. And it's also nearly the end of the movie. But this was just the start of the financial crisis. A crisis which is still causing ripples today in terms of monetary policy and even changes to financial regulation.
I've been at this place 34 years. And I can tell you from experience that people are going to say some very nasty things about what we do here today and about what you dedicated a portion of your lives to. But have faith that in the bigger picture, our skills have not been wasted. We have accomplished much, and our talents have been used for the greater good. Here's your packets. Get to work.
If you enjoyed this, please like and subscribe to our channel for more reaction videos and career-related content.